行，其实他用这个的话，用 YouTube 的话，他那边应该是看不清 PPT 的。
哦。
那边看不清 PPT。
看这个太亮了。
对，没办法，只能这样，对吧？那你用那个快手是可以的，对吧？
大我就看得清楚。
哦。
我要买那个电脑就挺短的呀，没有还能看得清。你看它就会自动调那个曝光，它这个电脑的摄像头。
是啊。
对，就想让您清楚，然后所以这个就得特别亮。
明白了。也可以。对，这样啊，确实是。对，这就可以能够清楚一些了，至少能清楚一些。还得稍微再远一点。
这个焦点它也不能对焦。这样就是，如果它自动把焦点识别到这个背景，您就黑了。然后现在是可以的，然后它一识别您又那什么。
啊，就是。
就往这边来的。然后您看，就它会自动。
它自动识别。
对，就自动。你看这样就好了。
对。
所以您都是您往那边站来，就是您要上课的时候就有个固定的位置，就它会识别脸，所以有时候都不清楚，就这样吧。
对，这样。下面还有这个快手上面，快手这个我应该站到哪个位置？
这儿就行。
站到这就可以了。
这就可以了。
站到这就可以了。我没事，你可以往前站一下。对，我可以往前站一下。
这就行。梁雅兰是您学生吗？
应该是吧。
梁
雅兰是。
哦，那他在。
是。你看 YouTube 上。上周Sam在家看了，觉得怎么样？效果一般。
就我感觉有点紧张。
是吧？
对。
有点
我就感觉出来有点紧张，可能是第一次直播嘛。
可能是第一次到。对。而且上次没有人。
对，就我。
声音那个麦。
那个麦不用了吧？就是这个麦连这个，我觉得收音还是本相机收的好。
收的好一点。
那个麦好像跟这个音质不太符。
是吧？声音的话，对，你要是
声音没问题。
声音没问题。可以，我觉得差不多去了，可以。我看一下有没有，我也不知道这个它上面，好像应该是有人看吧，不太确定。好，那咱们可以对上周讲的话，你有什么就是问题啊？哪块没有觉得挺有意思但是没有？
我就记得有个什么 life cycle business cycle。
什么对。
那讲了，如果加息的话，就是 stock market 还有那个 asset 就会缩水。
对，
我就记得这些了。
这是非常重要，这非常重要。就是很简单的一个 logic， 就是在加息的时候，为什么要加息？因为
经济不好。
不是经济不好，是 inflation， 就是有通货膨胀。有了通货膨胀呢，唯一的办法能够压制通货膨胀，就是价格在大众商品的价格呀、油价呀、菜价呀各种价格都往上升，对吧？那唯一的方法就是加息，就把利息升上去。把利息升上去的话呢，可以压制这个 就是能够减缓这通货膨胀，然后把它压制下去。那为什么有这个通货膨胀出现呢？为什么有通货膨胀知道吗？就为什么这个出现价格这个
之前
变得
以前上学的时候好像有人讲过，
啊，
为什么
就很简单，
是因为金融市场问题，金融市场
钱多了，
哦，
对吧？一个你像 COVID 之后呢，就是2020年，每个国家像美国呀，其他国家跟着都印钱，就发钱发福利，对吧？给个人发福利，那钱从哪儿来的？就印出来了。所以在市面上流通的货币多了之后呢，它自然而然这个钱就贬值了嘛，然后就贬值了。那现在唯一的方法就怎么样把这个货币收回来，就是说是正常是它通过政府是通过这个买卖这个fixed income 来把这个回流回来。现在就做的是正是这个把钱发出去的印的钱发出去的慢慢往回收回来，就是抑制它这个通货膨胀。就钱少了，市面上流通的钱少了，本来是2020年之前，对吧？可以1块钱买一个那个，就是说买一个笔，对吧？一支笔，那因为发的钱多了，就变成1块5能买一支笔了。
哦，
就这意思。那现在呢，就要把这个钱慢慢要收回来，市面上的钱的流通减少，就把这个价格慢慢压下来。所以这个是很简单一个，就是比较简单一个 logic。
就是钱印多了造成 inflation，然后为了压制 inflation 就是印钱，就是加息嘛。
对的。然后呢，你知道这个简单的 logic 之后呢，就可以想到什么时候是买股票，什么时候是卖股票。所以今天我会讲一下股票这块，对吧？因为你知道这个简单的这个 logic 是怎么样，是什么时候产生通胀，对吧？政府印钱会发生什么？这些东西对股市有什么影响？对于债券市场有什么影响？那就知道大概率的，就是说，我这时候去买点，回报率要高，要比其他时间买要高一些。差不多就是这个还是实际还是看一些例子的话，还是比较有用的。OK， 所以我们可以。我这块有2个那块，我觉得现在可以开始。Okay, let's get started. Saturday Night Live from Telemaster, Winnipeg. Okay, so last week we talked about the personal finance in terms of investments, type of investments. We didn't get into the details. So, what are the type of investments? For example, the short-term investments, common stock, which is equity, fixed income, mutual funds, and ETF, hedge funds, derivative, and other property investments. We also cover what are the career path in the investment industry, how much you make, what's the job titles you work. So today, our focus will be on the common stock. Okay, the common stock. And as you know, like the stock markets were always fluctuate. So the example for this year, the overall market was down roughly like 20% something. Most of stocks was down like 50%. So there's some good years, bad years, but back in 2 years ago, 2020, after I think it started July or August. In the beginning of the year, because of COVID, the market crashed. So, and the government started printing money to bail out the companies, and the interest rate is getting near to zero interest rate. That means company can borrow money with no interest payments. So that saved a lot of companies at that time, and that drove the stock market boom at that time. So started 2020, I think August or September, the market going up until beginning of this year. So we have roughly like over a year and a half bull market. Now this year is kind of doom market, right? So boom and doom is happens all within the COVID period, and we consider right now COVID hasn't finished yet. So that's what tied to what we talk about inflation, interest rate, and how those will be impact the active market. All right. We're gonna get into the details a little bit more. Start with. Okay, moving. Okay, there we go. Okay. All right. 1 second. This is not move. Okay. I gotta fix this. This is not moving. Second. No. Pages. Okay, now I think it works. There we go. Okay. Security analysis. So we'll talk about stock analysis. In general, here we go back to the paper. So what the academic is saying. There's somehow it's also related to what the industry, the professionals are doing as well. But at the end, we'll tell you what make it very simple, easy, how to tap into the good environments and how to get away from the bad investment environments. It's a current analysis is part of formulating long-term investments. So we talk about in terms of as financial advisor or even for the personal investments, we always consider long-term. So investments compared to speculating is different. Is completely different. Okay, when we referring to talk about investment, we're referring to long-term investments. Okay, we don't considering the short-term speculating activities such as we buying stock, the day traders, right? They buy and sell stock within few seconds or within a few hours. So here we consider long-term investment. When we consider long-term investment, would be based on how to the company's fundamentals. What are the company's fundamentals? Will be whether or not the company's making profit, right? How fast the company can grow, right? How fast the company can capture the market, and what's the profit margins are. So based on those, we'll talk about principle of security analysis and efficient market. Efficient market is actually it's a big topic. Is some people believe market efficient. So what does efficient market means? If the market is fully efficient, that means everybody knows everything in the stock market. So there's no such people who knows like inside information. So that's not true, right? Based on the efficient market, people, all the investors are not making actual investment returns because everybody knows everything. Right? But in reality, we are really living in, I'll say, semi-efficient market, right? That people knows the inside information, but they cannot trade on those information, right? There's people who has access to the information probably a few minutes or a few hours, few days earlier than the most of investors. For example, right now people, using the computerized training programs they call algorithms. Right? When they apply those algorithms, they can get information within like few seconds early than other investors. And then they can use that a few seconds advantage to making profit to buy or sell. Okay. So So definitely like understanding what the efficient market means and understand what the current market does is efficient or not efficient. That will be driven by what you believe and how you're going to formulate your investment strategy. All right, so start with the security analysis. Basically, there are two terms. One is security analysis, this is company analysis. Security here referring to the company. Okay? So intrinsic value, second term, what is really the company worth. For example, everybody knows Tesla, right? So here I say Tesla analysis. How are we going to analyze Tesla? How much the Tesla company worth and what's the real value of the Tesla's common stock? So first of all, like the process we referring to security analysis, we can look at Tesla's website, know what it does, right? What's their business, what their advantage, what's the financial statement looks like, and who runs the company, right? And all those we put together, gathering information, organize it into a logical framework, and then using the information to determine the intrinsic value of common stock. So based on all those informations, typically we're using discount cash flow models, DCF, or multiple valuation models. Put those numbers into model, and we're forecasting what this Tesla will be producing next 5 years and 10 years, number of cars, number of vehicles, and what's the price going to be. And then we can discount those back to the present and kind of formulating some range of a price, let's say between $150 and $200 per share. And that will be kind of means the intrinsic value, so the measure of underlying worth of the share of stock. But in the reality, does anybody knows what exactly Tesla, the stock price would be? No, right? Nobody. If anybody knows the stock price is going to be, they can easily become a millionaire or billionaire. It's so easy. If I know any stock, tomorrow's price, I just put all my money into that one stock. So the intrinsic value is always come with a range, and it always changing based on the expectation, based on the forecasting. And so in the stock market, is nothing is certain. That's you can consider it as a kind of like a gambling, because nothing is certain. Nobody will knows what is the stock price going to be tomorrow, or in next few days, next month, next year. Nobody knows. Right? But they can have somehow doing some sort of analysis, based on analysis, make a logical and rational decision. But does the decision means right or wrong will be based on the Mr. Market. And so the Mr. Market, as a stock market called Mr. Market, the market is always right. But the investors can some 50% right, 50% wrong, right? So don't get into what, the intrinsic value, if I know the intrinsic value and I know the price of the stock, that's not that's not a fact. Okay. All right. So we talked a little about discount cash flow model, right? So first of all, we estimate the stock future cash flows. Okay, stock future cash flow, how much the company can generate. Get back to the example Tesla, right? When we do the forecasting, we'll forecast the next quarter, how many vehicles, Model X, Model Y, how many vehicles they can produce based on their current production capacities. Okay? And they're also expanding as well. They're building facilities in Germany. They get mega factories in China, right? They also building other factories across the globe. So even though we can forecasting the cash flows, number of vehicles, but nobody will actually know what's Elon Musk's plan, how many factories or manufacturers they're going to they're going to build over the next few years, right? Even Elon Musk, maybe he doesn't even know, right? He has some good ideas about how he's going to expand, but he may not exactly know what's the future cash flow for Tesla in the next 5-10 years. Right? So it's all about estimate, right? It's all about estimate. So the cash flow. So when we estimate number of vehicles that Tesla can produce, now estimate the price of the vehicle, each vehicle, right? So the price also changes as well, right? The Tesla as a Model X or Model Y, Model 3, they can price typically they can go up if there's more people buying, or the company can reduce the price, right? So for example, just a couple months already, they think they reduced Model 3's price, like $5,000 a vehicle. Right? So there's a lot of uncertainties, so many uncertainties, but we have to do some forecasting, right? So based on our forecasting, we got number of vehicle times price, and we got the revenue. Right? Revenue, then we're forecasting the expense, and we got what's the cash we can generate from the future productions. Right? And discount rate. So that tied to how we're going to value the company. Discount rate basically interest rate. Okay, based on the interest rate. Each company has their own discount rate. They call weighted average cost of capital. So they based on their equity and fixed income borrowing rate. So, but meaning is driven by the interest rate. So that's directly linked to the what happens, why the central bank increased interest rate will have significant impact, negative impact on the stock price. Right? Just example, Tesla's price, stock price, after the Federal Reserve, so Federal Reserve, Central Bank, the same thing. Right? U.S. called Federal Reserve, in Canada called Bank of Canada, central bank. So the same thing. When the Federal Reserve starting to decrease the interest rate, right? Decrease the interest rate. So it's really based on the interest rate, decrease the interest rate, and this is numerator. This is denominator. So the interest, when interest goes down, right? When we calculate, when we divide by the interest rate, the value goes up. Right? So that's simple math, simple mathematics. Right? So you can see what happens after COVID. Right? All the banks, central banks across around the world starting reduce the interest rate, and the stock market start booming, especially for those tech stock, technology sectors start booming. So if you're looking back, Tesla stock, I think it was at the highest point like $700 per share, from I think it's from around $200. All the way it goes up to $700 per share. And people making big money on Tesla's stock. If you know, the last time, I think 2 weeks ago, we talked about Reddit. If you haven't heard of Reddit, it's a social platform. You can post in messages, right? On the platform, people mostly is retail investors. Retail investors like us. It's not big Wall Street or Bay Street guys, right? So they on the forum, they're posting what stock price will be, what they buy, and everybody get excited, so they start buying. One strategy they did very well was they buy the Tesla stock shares. At the same time, they buy options, call options. Okay, they buy call options. So what this call option means? A call option give the investors right to buy shares. Okay, let's say Tesla stock's price at that time that's $200, right? As small investor, retail investor, I don't have lots of money, right? If I have $2,000, I only can buy 10 shares. 10 shares only. So if I know the stock price is going to go up, right? If I kind of I'm expecting the stock price going to go up, and I want to maximize my returns, maximize using some leverage. Okay, so then the options come into play, called call option. So there's call and put. Let's start with the call option. So I say I have $2,000. If I buy stock $200 per share, I can buy 10 shares. And on the in the alternative, I can using option. I can buy options. One option is 100 shares. One option is 100 shares. Okay, what this call option do is give the shareholders right buy a stock at a certain strike price. Okay, so let's say at that time nobody will guessing that the Tesla price will be $500 from 200. Let's say $400, double to $400. Nobody will think that will happen, right? So, but somehow, as a retail investor, I want to take that risk. I think it's not going to be like way higher than $400. So I'm going to buy $400 strike price call option at $1 per share. $1 per share. Okay. So $100, 100 shares will be $100, right? So I can buy 2,000 shares. I can buy 2,000 shares of options, right? So that'd be 20 options, right? 20 options. So 100 shares per option, right? By 20 options. So that means I have the right to buy 20 shares at 20 options. That means represent 2,000 shares at the price of $400. Okay, and access. Let's say I have a 6 months. I have 6 months of time to do that. Once past the 6 months, the option will be expired. Okay, and guess what happens? The stock market start booming, right? And Tesla's price start rising like a rocket, goes up, all the way goes to up to say $500. I think highest $700. Let's say $500. Okay, so let's calculate the returns. I paid $1 per share for options, right? $1 per option per share for options, right? So $2,000, I can get 2,000 shares. When the price goes up to $500, I can buy at price at $400. That means I'm making profit of $100 per share. Now, how many shares I have? 2,000 shares. Okay, so 2,000 shares times 100, that's like $2 million, right? $200,000. Okay, so I make, let's say, based on that, I made $200,000 based on $2,000 investments. Right? So if I'm buying, comparing to, if I only buy shares, buy 10 shares, right? I can buy 10 shares at $200, and the share price goes up to $500. My profit is $300. $300 times 20, $6,000. So you see the difference, right? You see the difference. Yeah.
Could you explain more about what is an option?
Okay. The options give the investors right to buy or sell underlying asset. The underlying asset means just referring to this stock, that means let's say Tesla. So there's a call option and put option. No matter call or put, they always have the option price, they have a strike price, and they'll fluctuate based on the underlying asset, and you have expiration dates. You can buy if you I said one thing, if you want using that leverage to make you maximize the profit, and you expecting the price going to go up, by call option. And if you expecting the price goes down, you can buy put option. Okay. So call option give you a right to buy at the stock share at a certain price and within a certain period. So that kind of is considered as a leverage, So that's an example, but for retail investors, definitely we kind of avoid using. It's very, very risky. So what if, let's say same example, you bought strike price $400 per share of Tesla. What if the price didn't go up to $400, only goes up to $300, or didn't go went up at all? It actually goes down. So that's the $2,000 I invested. It can become zero and nothing. Okay. In contrast, if I buy shares, at least if the price goes down to $100, I still have 20 shares, right? So, so that's kind of like it will based on the the investors' risk profile. All right, so let's get back to the. So now we forecast the cash flow. We forecast we kind of know what's the discount rate, right? And we can calculate based on the future performance. We can calculate the intrinsic value of the company. But that's all about expectation, right? About expectation. All right, so that's here we can get into the there's bottom up and top down. Okay. Top down means we analyze the economic environments first, then we get to the industry level, and then we analyze in the individual companies. So that's from top to bottom. Okay, that's typically it's pretty hard, except for retail investors. How could we know what is the economy going to look like in the next 6 months? Even the economists don't know, right? How could we know? So it's pretty tough to do, but there's companies or investment firm that does apply this strategy, but it requires a lot of expertise to do this analysis. So you have to have a sense of what is it, the overall economy going to look like, and you have to know what which sector going to be outperformed, with what are the good sectors to invest. For example, the real estate is, it's going to be perform really well in the next month based on their analysis. So they will only look into the companies in the real estate industry. If they think the technology, let's say cryptocurrencies or the blockchains, those are going to be outperformed in next 6 months or next year or so, they're going to look into the blockchain companies. So that's kind of like an example. Okay, so then we talked about the efficient market. So it's based on how we're going to believe it. But some people believe it's efficient, some people believe it's not efficient, but basically, there's always a misprice. People, I think, I believe that people cannot predict the market. Some people could be lucky. Even Warren Buffett together sometimes get it wrong, sometimes get it right. So, and consider it's only buying few companies over time, and still he can get it wrong. Like ABM, there's a company that he bought, I think it's from UK, and he lost, I think it's over 100, 200 million dollars. So, in terms of efficient market, I think based on the experience, is the market is somewhat efficient. Over time, is efficient. I see the market over time, it can become efficient. So when the informations from different channels getting to most investors, in that term, is somewhat it will become efficient, but it's not really like efficient, very efficient, pure efficient market. Let's put that way. So another example adding to this is there's lots of hedge funds. They do algo trading. What does algo trading means is they read computer program and they trade based on using computer for the tradings. Right? They trade themselves. So the speed of trading they can get into milliseconds per trade. Okay? They're using that inefficiency in the market to making profit within milliseconds. Buy and sell, they will. And there's a very famous investor called Gene Simmons. He has lots of mutual funds. He hired so many PhDs in physics in all different areas. And what they do is they are profit from the inefficiency of the market. That way, inefficiency of the market. If the market is efficient, they will not able to do it. Okay. So that's also states the market is not efficient, but over time will become efficient in a way. Okay. Fundamental analysis. And we talk about intrinsic value, right? Fundamental analysis basically people like Warren Buffett. Okay, Warren Buffett style is fundamental analysis. They'll look at the companies, the business. They look at the financials. They look at the future of the business or the industries. Even they consider the economies as well. So most recent investments Berkshire Hathaway made was into the chip maker from Taiwan. That's big investment. So they kind of right. They must see something like gonna happen. So, all right, economic analysis. We talk about this. Also tie back to the business cycle, right? Talk about business cycle. So one, let's say no matter how good you are as an investor, you're most likely not making money this year. But there's some investors making big money. They're shorting the market. So there you can in the market you can long. Long means you believe the stock price is going to go up, so you buy. If the price goes up, you're making money. In contract, there's investors. They can short market. That means they can borrow the shares at let's say $100 per share Tesla. They can borrow it right now, and then when Tesla price goes down from 100 to 80, right? When they borrow, they sold them shares right away. so they sold to the market. Okay, so when the price goes down to 80, they can buy back. They will buy back. They will buy back the price share all the shares they borrowed at $80 and pay the share back to the lenders. So they're making $20 per share profit. So then that's kind of shorting the market. So if people are shorting the market this year, they're making money, they're making profit. But for retail investors, it's very hard to short. It's very risky, right? You have to time in the market, and it's not easy to do. So most of the retail investors like us, we are long, we're not able to short. But in this year, no matter how good you are, you cannot lose money if you're long, right? Because most of the price and all the price of the stocks went down this year. So, so that's kind of tied into the cycle, right? If the market in this downtrend cycle, and you consider we are long, you're not going to make money, no matter how smart you are as an investor. You're not going to make profit because the overall cycle is like that. We are in that cycle. Key economic factors. So that's one of big factor right now. All the economists, all investors talking about is the inflation, right? The CPI. Okay, the CPI. So consumer price index for this now reflects on the inflation. What the inflation kind of looks like. Economic outlook. So that's kind of what we believe based on current economic factors. We will consider what it looks like in the next years, next 6 months or next year. So the economy and the market. Okay. Okay, Sam. So good question. When the economy is doing really well, does the market goes very well at the same time? What's the relationship?
I guess so.
Yeah.
Yeah.
So that's I think most people believe, right? In long run, it's true. In long run, it's true. But in the short run, it's not. It's not. Okay. There's a lag between how the economy performs and the stock market. Okay. They are not parallel. They're not parallel. Example. There are so many examples. Let's see. There's 80. Okay, that's 2000. 2000. There's a tech bubble, technology bubble. Okay. So when the technology bubble burst, what happened to the economy? The economy went down, right? But the Federal Reserve from that time start reducing the interest rate. The stock market performed really well, even though the economy is not doing so well. Okay, so that's one example. 2008 financial crisis. Okay, when the 2008 financial crisis occurred, the economy went down to the drain. Right, it's really bad. But what happens when the Federal Reserve starts decreasing the interest rate? From 2009, the market goes up, all the way up. Right? So it's not, same example, 2020, when COVID happened, and the economy is really bad. 2020, 2021, actually the economy is not doing well. Look at the stock market. It's outperformed. Tesla, I think, was triple or quadruple. You see, within that 2 years. So many stocks, they won the 5 times, 10 times. It's crazy. The market went up like crazy. But the economy, overall economy, is not previous law. We experience that, right? So so there's misconceptions about the economy and the stock market, and I think that's a textbooks fault, because that give students the wrong impression. The economy and stock market is a parallel. When the economy is doing well, the stock market is doing well. But in long run, it's true, right? But in short run, it's not. If you heard of what, so I think it's Larry Page or Warren Buffett, probably Warren Buffett said, when the street are in fear, when the blood on the street, it's time to buy. Right? It's time to buy. So when everybody is celebrating, they're making money in the stock from the stock market. Everybody, I mean, all the retail investors, everybody making big money from the stock market. That's the sign of sell. Right? That's a sign of sell. So it's opposite. It's opposite from what we learn. But that's still true, right? That's still true for starting this year, last year, 2021. So many investors, small investors, get into the market. Young people, they using Robinhood, well, simple. They don't pay commission. They just simply buy stocks and sell, buy and sell. The wrong impression is everybody can make money from the stock market. Guess what happened when they get in the market? What happened this year? Market crossed, right? And who's get out of the market first? The big guys, right? Wall Street guys. They get out first, and who's holding the bag? And the small investors. Right? So, so definitely, I mean, in the long run, I can see the long run definitely stay true. But if you narrow down into a couple of years, right, it's not. Okay. What time is it?
7:48.
I think cover a bit more business cycle, as we talked about last time. GDP, course, domestic products. That's factors. Typically, right now it's in the developed countries 2%. In China, right now it's 7%. It's pretty good. Like before, it's like 8-10%, but mostly in the developed countries, like aiming at 2%. Industrial productions and another indicator output produced by the industrial companies, kind of import export. So there's one big factor. Indicators will be from China. So how much the manufacturer from China they export products into other countries. That's gonna very good indicators to see what's the production is going to be like, consumption is going to be like, right? Because we under the assumption of the business, they have to foresee the growing and the demanding is going to pick it up. Then they can place the order. But you have to place the order first. Let's say I'm asking, I'm placing the order to produce a million pens, right? And the manufacturer in China, they have to take a few months to produce, right? Or a few weeks, and they have to ship to here. So it takes a while. It's not like a few days. It can be a few weeks. Some will be a few months. Right? So when the demand for those kind of exports goes up, you kind of have a sense the business or foreseeing a growth in general, right? Key economic factors. I think right now it's really monetary policies. It's all about monetary policies. In the textbook, they always talk about fiscal policy, a mix with monetary policy can move the economy and make, drive the economy growth, right? But at this, and for also for last like 10 years or so, it's all about monetary policy, and it's all about interest rate. So that's the key. Getting back to the interest, so it's very simple. I think I can wrap it up and talk about what's the interest rate, inflation, the impact from very simple logic. Every time when there's a crisis, the one thing the Federal Reserve or central bank did was decrease the interest rate. Why they decrease the interest rate? You know why? What's the reason? Whenever there's crisis, they'll decrease the interest. Why are they doing that?
So the value of the stock market can increase.
Well, yes, but that's not their intensity. They don't care about stock market. So the central bank don't care about the stock market.
To stimulate the economy.
To stimulate the economy, how they're going to stimulate the economy? One is when the interest rate, consider lots of companies are borrowing money, right? Running operations, they borrow money. When the interest rate is lower, they penalize interest rate payments, right? When the interest rate like COVID 2020 near to zero, that means the company can borrow money paying no interest rate or very little interest rate. So when a company has that capacity to do that, they can borrow more money and stay alive. Right? If the Federal Reserve keep the interest rate status quo, they're not changing at all, lots of companies can run out to go bankrupt because they cannot meet the payments, right? So from the economic perspective, what Federal Reserve wants is to stimulate the economy, to keep those companies alive. As long as they stay alive, when the overall economy, when the crisis is over, they can start making profit, right? During the crisis, they can losing money, not making profit. That's okay, but because of interest rate, they can stay alive. Right? Otherwise, they will go back. Right? And two will be when they're printing more money, governments like helicopter money, right? So just give everybody money they can spend, right? To stimulate the economy. Okay, so it's all about the money. We call it velocity of the money or the money supply or it's all about the interest rate. Okay, so this if you talk about the stock market or bond market, it's all about interest. So whenever there's a crisis, the Federal Reserve will decrease the interest rate to stimulate the market, keep the economy alive, and the stock market will go up. And when there's too much money in the market, too much money, they are driving the inflation up. Okay, when the inflation up to a certain point, the central bank don't have any options but just decrease the interest rate to reduce the interest rate. Okay. And in Canada and in US, the central bank have a target inflation rate. The target inflation rate is 2%. So that's the aiming for. So as long as it's around 2%, they're okay. But for this year, they will be about 2%, maybe 6-7%, some even higher. That's why getting the central bank panic. So in Canada, the interest increase. It does the increase interest rate start with that April once, July, and August. Several times. It's never happened before like this. So the speed, how fast the central bank increased interest rate. Never happened like this before. All right, so the logic is very simple, right? So whenever there's a crisis, whenever the central bank start decreasing interest rate, the market going to go up, stock market will go up, right? The bond price, the fixed income, the bond price is going to go up because the interest rate and bond price has inverse relationship. When interest rate goes down, bond price goes up, right? And when there's too much money, there'll be inflation. When the inflation is way above 2%, every day see inflation's 2% or 3%, it's no worries. But if it's way above that, that's a 6, 5, 6, 7%, the central bank has to decrease interest rate. There's no other options. There's literally no other options but decrease interest rate. When they decrease interest rate, what happened to the stock market? It goes down, right? When I decrease interest, increase. When they increase interest rate, the stock market goes down, right? So, and the bond price also goes down as well. Right? So that's the simple logic. All right, so I can. I think we're kind of about the time. 3 minutes to 8. Any questions?
So earlier you talked about share and option.
Okay, so you're kind of interested in that.
No, I kind of confused about it.
Confused. Okay. Okay. That's kind of like, you know, it's not easy, especially you don't have that background, so it's hard to understand. Or let's say, okay, let me put it in a simple term. Okay. There's also using Tesla. Okay, Tesla. I can buy Tesla's options. I can buy Tesla's options. Right. Okay. Okay. Actually, I can show you. There's my phone over here. Okay. So, let me show you in the real term. Okay. So. Okay. Come on. Okay. So this is Tesla stock, right? Currently trading. So currently trading at $178.50. Okay. And here is option. All right. So when you see option, this side is called call option. Right? It's a call option. This side is called the put option. Okay. There's a bid ask price, so that means then for option price. And there's a strike price. Let's say 170. What is the price for $200? And we got the 100. Okay, right here. Okay, $200. So I can pay 90 cents per share to buy a call option at $200, but there's an expiration date, December 16th. Okay, so it's next week, next Friday, right? So if I believe by the time next Friday the price is going to go up to $200 even more, and I don't have lots of cash to buy Tesla stock, so I can just pay like a 90 cents per share to buy option. And if the stock price goes above $200 by the time next week, I'm making money. If not, I'm losing money.
Oh, it's like gambling.
Yes.
Oh.
Yes.
Oh.
And same thing as put option right here, put, right? Put options give you a right to sell a stock. So if you believe the share price is going to go down, right? And you can buy a put option and you're making profit on it.
So you buy calls.
When the price, you expect the price to go up.
So like if you predict the price will go up, you buy calls. If you think it will go down, you buy puts.
That put.
Oh, okay.
Yeah.
I see.
Yeah. Yeah, those, you have to see the example and to really have a sense of it. Yeah. But those are really risky. You can lose everything, right? So, and they have a time on it, timeline. You don't have a week, some options 2 weeks, a month, some options have a year. Right, so within that time period, if the price is not performing like as you expected, you can lose everything.
It's like buying a lottery.
It is.
Similar.
But there's strategies. There's people playing that. There's other strategies involved as well. Yeah. All right, good stuff. Any other questions? No? Okay, excellent. So we can wrap up today. Because very good to understanding, especially interesting options, and then you know a little bit about stock market, so that's kind of easier for me to explain about what the interest rate, inflation, the stock market analysis, fundamentals, interest values, that type of terms. But we'll cover more in terms of fundamentals next week. We'll continue with that. All right. Excellent. All right. Thank you. So we're gonna wrap up right now. I'll see you guys next week. Yeah.